Well, today we have a very different point of view once again about what's going on out there. First, I'd like you to alert you to a blog that I wrote in mid-December. It's on our website. And it goes into why we believe that innovation is in deep value territory, and goes through and refutes a lot of what we believe are the myths out there about innovation. We believe that COVID-19, the coronavirus crisis, accelerated the shift towards the innovation platforms around which we have based all of our research. And I'm going to give you a few examples of that in a minute. I do want you to know that, of course, we've been through a very difficult time since the significant rotation from growth into value started nearly a year ago in mid-February. And I want you to know that we're in there with you between the company and ARK funds, which are more than half of my IRA, and the significant percentage of my total net worth. We're all in, and my conviction couldn't be higher that the innovation that has been evolving and was accelerated coming out of the coronavirus crisis is unstoppable, and the convergence between and among the 14 different technologies that we are researching, that convergence is underway now and is causing and will continue to cause explosive growth, really the likes of which we haven't seen in our lifetimes. And when I say explosive growth, I mean when it comes to those innovation platforms, they're going to cause a lot of problems for the underlying economy, the traditional world order. And I'll explain a little bit more about that in a moment. So what has happened is in the early stages of the coronavirus, when I was doing those videos, we had algorithms and quantitative strategies focused on just a few variables. They were at that time cash burn and cash cushion. And a lot of our stocks did not have big cash cushions and were burning cash, especially in the genomic space. And they were taken down by 75%, many of them, in a month, just in a month, 3 weeks to a month. And of course, that was the wrong answer. The algorithms got it wrong, and that there was a massive head fake, caused a lot of consternation for the quantitative strategies out there. Because, of course, genomics was a big part of the solution to a problem we were facing in the coronavirus. I think we're going to see a lot of more hotspots in emerging markets, and the dollar going up suggests a flight to safety, and that is a downward force on inflation. Commodities are priced in dollars, the dollar's going up, all other things equal, commodity prices would go down. In the crypto markets, we're seeing a correction. They are starting to succumb to what we're seeing in the equity market, which is this strike against technology, growth, innovation. We think that's going to be short-lived. And the last one, blockchain technology. We think that we're in a period of innovation that was the dream in the late 90s. But those companies were vaporware. They were based on nothing but eyeballs. We have real revenues. We have incredible growth rates. And if we're right, and the economy has an inventory problem, then our growth rates are going to look far superior to anything you'd find in the value space. And we are really looking forward to that. And I'd like to just talk about the fourth quarter GDP. It will be strong. Now, not as strong as some people thought. It was going to be up 7%, and now I guess the Atlanta Fed said it'll be closer to 4.3%. What we're going to be watching is how much of that is in inventories, and I think quite a lot will be. Now on to market signals. And I realize I'm spending a lot of time, but I just want you to understand how we're pulling apart the data, and we're seeing things that others are either not seeing or for some reason just not reporting. The yield curve peaked at 130 it was February or March of last year. I think it was March, and has been falling. Now, the yield curve is the difference between short and long-term interest rates. Normally, long-term interest rates are higher than short-term interest rates. They were, as measured by the Treasury curve, so government bonds and notes, the yield curve, the longer-term bonds were 130 basis points, 1.3% higher than the 2-year yields in March of last year. At the end of last year, that number was 80 basis points, 0.8%. Today, it's 0.6%, even though bond yields are up, short yields are up more in response to the employment report and that 0.6% on average hourly earnings. The yield curve narrowing generally is not a good thing for financial stocks, but this rotation into value stocks, energy is up 5% this year, financials up, energy is up 10%, financials up 5%, and they were two of the strongest sectors last year. It seems to be on automatic pilot. This yield curve would suggest that financials should start to underperform. So we shall see. The rotation is still towards value. It is hurting growth. We think it's long in the tooth. We think it's going to end, but it hasn't ended yet. In the fixed income world, we're also seeing credit spread. So we look at junk spreads. So how much higher are low quality companies' yields or interest rates than higher quality? And right now, we're seeing no disturbances, very little. The fixed income market is buying into this rotation into cyclicals. They haven't been paying attention, perhaps, to inventories in the way we are. Commodity prices are quite mixed. Oil prices peaked in the early November timeframe, I believe it was, around $85, $86. They went all the way down to $62. So in the next couple of inflation reports, energy is going to be a negative. That's interesting. Iron ore prices are still down quite significantly from their peak, and that does corroborate with what's going on in China. But most are just meandering, most prices in trading ranges. The dollar is up, and that is causing all kinds of problems in the emerging markets. The Turkish lira, as I mentioned on our last video, the Turkish people have lost half of their purchasing power in 1 year relative to the dollar. That's the Turkish lira. It's gone from 7 to about 14. It was as high as 18, nearly 20. And I think it's going to go back there because their foreign exchange reserves were cut in half the last month to something like $6 billion. $6 billion is nothing to withstand the onslaught of the currency speculators. We're also seeing Kazakhstan, the protests there, shutting down the country's internet. I know Russian forces are in there. I think we're going to see a lot of more hotspots in emerging markets. And the dollar going up suggests a flight to safety, and that is a downward force on inflation. Commodities are priced in dollars. The dollar's going up. All other things equal, commodity prices would go down.